The more we hear the president actually say, I'm not happy with Jay Powell, I'm not happy Jay Powell, does that at the margins mean that they'll even be more independent and want to hike more, or do we just ignore it?
I think we probably ignore it. I'm sure the Fed will just look at the data, focus on what they need to do and make sure that they're setting policy accordingly. I think they'll sort of block that out. It's interesting, markets are not really reacting to these kind of comments, whereas, of course, the initial comments, markets were somewhat surprised. I think they've just become accustomed to it, and I think Jay Powell and the rest of the FOMC are going to stay the course.
What kind of data are we going to get from the U.S.? So I've heard I've heard we could see a slowdown, which means that the market is pricing in too many hikes, but I've also heard it the other way around. Some people worrying about overheating.
Yeah, I don't know. Maybe we're in the middle of that. But we'd say, look, the economy's definitely slowing. So we've seen the momentum slow. And if you look at the leading indicators, look at PMIs, they're slowing. But it's still growing at a very strong clip. Look at the employment report a couple of weeks ago. Unemployment's at sort of nearly a 50-year low. So, I think the Fed will look at that, look at the lack of spare capacity and say, yeah, we need to keep on this path. So we think they are going to stay the course. Now, the interesting development in the last couple of months, of course, has been the tightening of financial conditions. So in the past, the Fed was battling. They were raising rates, financial conditions were not really moving. We have seen that tightening of financial conditions. That's come about through widening credit spreads, a sell-off in the equity market. So when they talk about being data dependent, which of course we've seen numerous comments in the last few weeks, that's what we think they're referring to, is that they're watching those financial conditions. And so I don't think they're on a preordained course to hike by 2 or 3 times necessarily next year. Certainly December, I think, is a done deal. But it will depend on what financial conditions do. Our own case, central case is 3 hikes next year.
If you look at 2019, do you worry about interest rate normalization, or do you worry about geopolitics? What's going to be your biggest bet in portfolios that actually will kind of make or break your year?
Well, we worry about everything.
We
worry about all the downside. We get paid to worry. I think the financial conditions tightening and the impact that has on it, I think, is at the centre of this. Of course, we know the ECB will have stopped buying bonds as well next year. We've got a bit of the runoff of fiscal policy in the US. So just that combination, tighter financial conditions, less of a fiscal stimulus next year, the rest of the world, as you said, normalising or at least having conditions that are less accommodative. Just how much do things slow down? And that's the hard part for the Fed, calibrating how much it slows.
But is it tweaks, or is it actually, do you worry about something ugly happening? So dollar driving too much, another sell-off contagion in the emerging markets, and we kind of lose control?
Yeah, I think we worry more about an inflation surprise in the US, right? And that's, we look at the labour market, it's still really, really tight. Average hourly earnings, the highest they've been for 9 years. So if there's a surprise, we think it's probably going to come from US inflation. Now, the other side, of course, the politics and the situation in the trade tensions between China and the US play a meaningful role in that. And who knows, we know we're having a dinner now between President Xi and President Trump, so maybe something will come out of that. But I think this is going to be an ongoing saga. I think that's going to be something we're living through all of 2019.